Do you work at Amazon? Then chances are restricted stock units or RSUs make up a big part of your compensation. But here's the thing, RSUs can be a powerful wealth building tool or a tax trap, depending on how you manage them. In this video, I will teach you how Amazon RSUs work, including how they are taxed. There will be a bonus tip at the end where I will share our secret 20-60-20 strategy for Amazon RSUs. Many Amazon professionals we meet, engineers, product managers, team leads, are so focused on their day-to-day work that RSUs just feel like future money. But then vesting happens, then boom, unexpected taxes, too much stock in one company before they know it, and missed opportunities to grow that wealth in smarter ways. One of our clients never sold a single share of her RSUs until it hit $1 million, which is great. But then her husband, who held a senior position at the government, was ordered to divest all that shares worth $1 million. You do not want to be in that position. So how do Amazon RSUs work? When you're granted Amazon RSUs shares, you're not getting shares right away. They vest over time, meaning they become yours gradually as you continue working there. Amazon wants you to continue working there. Amazon's vesting schedule is unique, and here's the standard breakdown. After 1 year of working there, you get 5% of the Amazon shares, they vest. And then at the end of year 2, another 15% of your Amazon RSUs vest. And then after that, every 6 months in years 3 and 4, 20% of your RSUs vest. That's called backloaded vesting, and it's designed to retain top talent like you. But it also means most of your RSUs vest later, so planning ahead is key. Once you're in Amazon, you may also receive refresh grants. These are new RSUs based on your performance. These usually vest more evenly and can build a layered stream of equity income. So how are Amazon RSUs taxed? When your Amazon RSUs vest, that stock's value becomes taxable income, even if you don't sell a single share. So let's say 100 of your RSUs vest and Amazon stock is selling at $200 per share. That's $20,000 of RSUs that just hit your brokerage account and is considered taxable income. Now, Amazon typically withholds 22% for federal tax purposes, but if you're in a higher tax bracket, let's say 32% or 35%, that can leave a big tax shortfall. Now, if you're a senior product manager at Amazon, 100 of your RSUs just vested at $200 a share. Again, that's $20,000 in taxable income. At 32% tax rate, for example, that's your marginal tax rate, you will owe $6,400 in federal taxes. But Amazon only withholds 22%, which is $4,400. That leaves you with a $2,000 tax shortfall. Here's an expert tip for you. You can also hold Amazon RSUs for more than a year, and after that, you can sell it for a lower tax rate, capital gains tax rate. But it also increases your exposure to stock market risk. So it's all about finding the right balance for your situation. If you're feeling unsure how to handle your RSUs, you are not alone. At District Capital Management, we work with professionals like you, Amazon employees in their 30s and 40s, helping them make smart, tax-efficient decisions. Click the link in the description to schedule a free discovery call today if you are looking for a fiduciary financial advisor to help you maximize your Amazon RSUs. Now here comes the bonus tip, the 20-60-20 strategy. Let's say you've been working at Amazon for several years now and you've managed to accumulate a handsome amount of RSU stock and you don't really want to part with it. Actually have a client who was so gung-ho with Amazon, he wanted to put all of his money literally in Amazon shares. So we get it. Selling your Amazon stock can feel like letting go of potential future gains. That's why we use a simple but powerful 20-60-20 strategy with many of our clients, and here's how it works. The first bucket, 20% of Amazon shares of our clients, we sell right away to fund a specific goal. Let's say they've been meaning to put down house down payment, they want to buy a house, or maybe upgrade their car. 60% of the client's Amazon RSUs typically go to the second bucket that we call systematic liquidation, where we sell Amazon shares systematically over 3 to 5 years, either quarterly or annually. We sell shares with the highest cost basis to minimize taxes. We then invest the proceeds in diversified ETFs to help them build their wealth. The third bucket we call the FOMO bucket, where 20% of the Amazon's RSU shares they get to keep just in case Amazon like 10x's or 100x's over time. This 20-60-20 approach helps balance growth with risk while keeping your goals front and center. And it's going to be different for each client. It could be a 30-60-10 strategy or some other combination.